Welcome back, deep divers. Have you ever looked at a company's financials and, well, felt like something was a bit different? Like the rules you thought you knew didn't quite apply?
It happens more often than you might think.
Right. So today we're pulling back the curtain on something called special purpose frameworks. Sounds a bit technical, I know.
It does, but it's actually incredibly practical.
Yeah, and understanding these can seriously sharpen how you read a company's financial story. It's not always about the standard GAAP playbook.
Indeed. While GAAP, generally accepted accounting principles, is what most people hear about, there's this whole other universe of reporting that's perfectly legitimate, widely used, especially, by smaller companies or for very specific situations.
Okay.
So our mission today is really to unpack these alternatives, help you understand what they are, why a company might choose them, and crucially, how they differ from what you typically expect from, say, a big public company's report.
Got it. So we're getting the full picture, no matter the lens. Let's dive in. This is your shortcut to understanding these, well, sometimes hidden layers of financial reporting. More than just terms, it's about the why behind the numbers. Okay, so let's start right at the beginning. Special purpose frameworks. What exactly are we talking about here? It feels like something operating outside the usual rules.
Well, yes and no. They are outside of GAAP, but they have their own legitimacy. They're also known by a slightly more formal name, other comprehensive bases of accounting, or OCBOA for short.
OCBOA, okay.
And the key thing, as you said, is that they are non-GAAP presentations.
Right, non-GAAP. And for some people, that immediately raises a flag, doesn't it? Like, why wouldn't you just use GAAP if it's the standard?
That's a really common reaction and a fair question. But
Right.
hearing non-GAAP here shouldn't automatically mean less reliable or trying to hide something, not in this context. These OCBOA frameworks have widespread understanding and support precisely because they meet specific practical needs. Think about it. GAAP can be incredibly complex, sometimes prohibitively expensive, especially for smaller organizations.
Right, the compliance burden can be huge.
Exactly. Or sometimes GAAP just isn't the most relevant way to present information for a particular user. Maybe a small business owner just needs to know their cash position, or a regulator needs very specific information. So think of OCBOA less as a deviation and more as an alternative lens tailored for a specific purpose.
Fit for purpose reporting, I like that. So what are the most common lenses, the main types of OCBOA we're likely to run into?
Good question. There are several, but the ones you'll encounter most often are really these three.
Okay.
First, the cash basis and the modified cash basis of accounting. This is probably the most intuitive one. It tracks money in, money out. Simple.
Tracks the cash. Makes sense.
Second, the tax basis of accounting. Here, the financial statements are prepared using the same methods the entity uses for its income tax return. Very common in private companies.
Ah, okay. Aligning the books with the tax filings. I can see the appeal there.
Definitely streamlines things. And then beyond those, you also have frameworks based on a definite set of criteria with substantial support. Things like price level adjusted statements, which you might see in high inflation environments, though they're less common generally.
Right.
And also regulatory bases of accounting. Think banks, insurance companies, industries with specific regulators who demand reports tailored to their oversight needs, often focusing on solvency.
Gotcha. So specialized rules for specialized industries.
Precisely. But for our deep dive today, we'll really focus on those first three: cash, modified cash, and tax basis. They're the most prevalent and give you the best sense of these alternative approaches.
Okay, so if these aren't GAAP, they can't just be the Wild West of accounting, right? There must be some ground rules, some guidelines they do have to follow to ensure they're still, credible and understandable.
Oh, absolutely. That's crucial. You can't just make things up. There are clear guidelines from professional standards that apply across the board to all OCBOA financial statement presentations. It ensures consistency and transparency, which are fundamental, regardless of the basis.
Good. What are those key rules?
Okay, first up, and this is something you'll spot immediately, distinct titles. The titles of the financial statements must be clearly different from standard GAAP titles.
How so?
Well, you wouldn't just see income statement. Instead, you might see statement of cash receipts and disbursements, if it's pure cash basis. Or maybe statement of assets and liabilities, income tax basis.
Ah, so it flags right away. Hey, different rules apply here.
Exactly. It's a clear signal. No ambiguity about the basis being used. Second, the required financial statements are generally the equivalents of the ABA balance sheet and income statement. Yeah, meaning they serve the same core purpose, showing financial position and performance, even if the names are different, like statement of assets and liabilities, modified cash basis, instead of balance sheet. The information structure follows the chosen framework, but the goal is still a comprehensive picture, just painted differently.
Okay, makes sense.
What else? Third, they must explain changes in equity accounts. Just like under GAAP, users need to see how the owner's stake, or the net assets, have changed over the period. It connects the dots between reporting periods.
Right. Tracking the equity is fundamental.
Absolutely. Fourth, and this is a big one, a statement of cash flows is not required for OCBOA presentations.
Oh, really? That's a significant difference from GAAP.
It is. For learners especially, that's a key distinction. Under GAAP, that statement provides so much insight into liquidity and cash generation. But with some OCBOA, like pure cash basis, the income statement is essentially a cash flow statement already. For others, the focus is just different, or cash flow info is embedded elsewhere.
Interesting. Okay. No required statement of cash flows. What's the last main guideline?
This one's arguably the most important for transparency. Comprehensive disclosures. Even though it's non-GAAP, the disclosures in the notes to the financial statements should be similar in depth and quality to GAAP disclosures.
So the notes are still critical.
Absolutely critical. This includes things like a summary of significant accounting policies, explaining exactly how they apply the OCBOA rules, what choices they made. Very important.
Because the rules aren't as standardized as a GAAP.
Precisely. It also includes informative disclosures similar to GAAP for any items that are comparable. If they report something like inventory under modified cash basis, the notes about it should be similar to what GAAP would require.
Okay.
And finally, disclosures about things not even shown on the face of the statements, like related party transactions, major events happening after the year end, significant uncertainties like lawsuits. That crucial qualitative context still needs to be provided.
So even if the core statements use a different basis, the principle of full disclosure, of giving the user the whole context, remains paramount. It's not a way to hide the important stuff.
Exactly. Transparency is key, regardless of the framework. It's about giving users the information they need to make informed decisions.
Okay, let's get into the nitty-gritty then. Starting with the most common type you mentioned, the cash basis. It sounds incredibly simple. Is it really just cash in, cash out?
It is simple, fundamentally.
Yeah.
And that simplicity is exactly why many entities choose it, especially smaller ones or those not legally required to use accrual accounting. It's easy to prepare, easy to understand, very intuitive.
Right.
However, and this is the key trade-off, that very simplicity makes pure cash basis financial statements generally not a great fit for businesses with complex operations.
Why not? What kind of complexity breaks the cash basis model?
Think about a business that has significant accounts receivable, customers who owe them money, or accounts payable suppliers they owe money to.
Right.
Or maybe they hold a lot of inventory or have substantial investments in buildings and equipment.
Okay. Yeah, most typical businesses have those things.
Right. Pure cash basis doesn't really capture the economic reality of those situations well. If you sell something on credit, cash basis doesn't show revenue until you get paid, maybe months later. If you buy a big machine, cash basis shows a massive expense right away, distorting that period's results instead of spreading the cost over the machine's useful life.
So it's really for the small, very straightforward players where tracking the actual cash flow is the main, maybe the only critical financial metric. Who typically uses this pure cash basis?
Exactly. Under pure cash basis, revenue is recognized only when cash is received, expenses only when cash is paid. No ifs, ands, or buts. It's very literal. You often see it used by estates and trusts, certain civic ventures, and a classic example is political campaigns and committees.
Ah, political campaigns. That makes perfect sense. It's all about how much money did we raise? How much did we spend right now?
Precisely. For them, tracking actual cash donations and spending is paramount for managing the campaign day to day. There's less focus on long-term accruals and more on immediate liquidity and accountability for the cash handled.
And what do their financial statements actually look like under pure cash basis? Are they recognizable?
They have equivalents to the main statements, but they're drastically simplified. Typically two main ones. First, a statement of cash and equity. And in its purest form, cash is literally the only asset shown.
No receivables, no
Yeah.
buildings, nothing.
Nope. And no liabilities recorded either. No loans payable, no accounts payable on the statement itself. As a result, equity just equals the cash balance. It's incredibly bare bones compared to a GAAP balance sheet.
Wow. Okay. What's the second statement?
The second is the statement of cash receipts and disbursements. This is basically their version of an income statement, but it only tracks the cash movements.
So what's on it?
It includes revenues received when the cash hits the bank, any cash coming in from debt or equity financing, cash proceeds from selling assets, and then on the outflow side, expenses paid when cash leaves the bank, debt repayments, any dividends paid out in cash, and payments for purchasing assets.
So buying a big asset just shows up as a big cash outflow right there on that statement.
Yes, exactly. It directly reduces the net cash flow for that period, unlike accrual, where it would be capitalized.
Okay, that clarifies the pure cash basis. But you mentioned most entities eventually move to something else. Modified cash basis, right? What if a business grows a bit, gets more complex, but isn't ready for full GAAP?
Precisely. That's where modified cash basis comes in. It's extremely common. Many for-profit and not-for-profit organizations start with cash and then evolve to this hybrid method. It cleverly blends elements of both cash basis and accrual basis accounting.
A hybrid, okay. So it keeps some cash basis simplicity, but adds some accrual features.
Exactly. It tries to get the best of both worlds, keep it relatively simple, but add certain accrual concepts where they significantly improve the relevance of the financial information without going all the way to full, complex GAAP.
So it's like a stepping stone. But how much can you modify? Where's the line before it just becomes accrual anyway? Is it clearly defined?
That's a critical point. The modification should not be so extensive that the statements basically become accrual statements in disguise. The underlying principle should still lean towards cash basis simplicity.
Right.
And crucially, any modifications made must have substantial support. That means the modification isn't just arbitrary. It has to be logical and consistent with how accrual accounting treats that specific item. You can't just pick and choose modifications to make the numbers look better. There needs to be a sound accounting basis for it.
Okay, so what are some common, well-supported modifications that companies make?
Some of the most frequent ones you'll see. First, capitalizing and depreciating fixed assets. So instead of expensing that big machine purchase immediately, pure cash, they record it as an asset and spread the cost over its useful life via depreciation, just like GAAP.
Okay, that makes a big difference to reported profit.
Huge difference. Another common one is the accrual of income taxes, recognizing the tax expense when it's incurred, not just when it's paid.
More realistic timing for tax expense. Got it.
Also, recording liabilities for borrowings, short-term and long-term, and the related interest expense, acknowledging the actual debt you owe and the cost of it, not just tracking the payments.
So you actually see loans on the balance sheet equivalent.
Yes, and maybe capitalizing inventory, treating goods held for sale as an asset until they're sold, matching the cost to the sale rather than expensing them purely when purchased. Gives you a more accurate gross profit.
Right, matching principle.
And sometimes, reporting investments at fair value and recognizing unrealized gains or losses, reflecting the current market value, even if you haven't sold the investment for cash yet.
That makes a ton of sense. These modifications clearly make the statements much more reflective of the actual economic situation assets owned, debts owed without the full complexity of GAAP. What about the statement titles for modified cash?
They also have specific titles to signal this hybrid approach. You might see a statement of assets and liabilities, modified cash basis, or perhaps statement of assets and liabilities arising from cash transactions. The key is including assets and liabilities now.
Because they actually exist on the statement, unlike pure cash.
Exactly. And for the performance statement, maybe a statement of revenues and expenses and retained earnings, modified cash basis, or statement of revenues collected and expenses paid. Again, the title signals it's not pure cash, not full accrual.
And the specific things on those statements depend entirely on which modifications the company chose to adopt.
Precisely. If they capitalize assets, you'll see assets and depreciation. If they accrue taxes, you'll see taxes payable. The statements reflect the specific hybrid rules they've chosen. It requires reading the notes carefully to understand the exact policies.
Okay, so we've got cash and modified cash. Let's pivot to that other major type, the income tax basis. You mentioned it's surprisingly well-suited for complex operations, unlike pure cash basis. Is it really just using your tax return as your main financial statement?
Essentially, yes, for entities that aren't required to use accrual basis. And you're right, unlike pure cash, tax basis can handle complexity quite well. Its big advantage is that direct link between operational reporting and tax compliance.
So it avoids keeping two sets of books, basically, one for reporting, one for taxes.
Exactly. For many private businesses, especially where the owners are the primary users alongside the tax authorities, this is incredibly efficient. It streamlines the accounting process, reduces costs, and ensures consistency between what's reported internally and what's filed with the government.
I can see the practical appeal there. But what happens if something financially significant occurs that isn't reflected on the tax return? Maybe non-taxable income like certain grants, or expenses that aren't deductible for tax purposes. How does a tax basis statement handle those? They still impact the business's true financial picture, right?
That's a really important point, and it highlights a key accounting issue for the tax basis framework. You're right. Just because something isn't taxable or deductible doesn't mean it didn't happen or doesn't matter economically.
You can't just ignore it.
No, you can't. The standards require that special accounting treatment must be given to these non-taxable revenues and non-deductible expenses that don't show up on the tax return itself. They still need to be recognized somehow to provide a complete picture.
How is that done?
Well, for cash basis taxpayers using the tax basis framework, these items are generally recognized when the cash is received or paid. So that non-taxable grant money is still shown as a cash receipt when it comes in. For accrual basis taxpayers, who might still choose to present their main financial statements on a tax basis, perhaps for simplicity or owner preference, these items are recognized when they are accruable, earned, or incurred, even if they have no tax impact.
And how are they presented on the statements?
There's some flexibility. They could be shown as separate line items within the revenue and expense sections. That's very transparent.
Right.
Or they might be presented as additions or deductions to the net income figure derived from the tax basis calculation, kind of like reconciling items.
Okay.
Or sometimes they're simply explained thoroughly in a note to the financial statements. This ensures the information is disclosed, even if it doesn't fit neatly onto the face of the tax-driven statements. The key is transparency, making sure the user knows about these non-tax items.
So even though the tax return is the foundation, there's still this layer of accounting adjustment needed to ensure significant non-tax items aren't completely invisible. And the presentation. Do tax basis statements also get unique titles?
Yes, absolutely. Consistency is key here too. Similar to the other OCBOA frameworks, the titles clearly signal the basis. You'll typically see something like a statement of assets and liabilities and equity, income tax basis, or just balance sheet, income tax basis.
Makes sense.
And for the income statement equivalent, a statement of revenues and expenses and retained earnings, income tax basis, or statement of income tax basis. The title explicitly tells you these figures align with the entity's tax reporting principles.
And the specific assets, liabilities, revenues, expenses listed would directly mirror what's allowed or recognized under the tax rules they follow.
Exactly. The elements depend directly on the income, deductions, credits, etc., reported on the entity's tax return, subject to those adjustments for non-tax items we just discussed. It's a framework built around tax compliance.
All right, so we've explored these alternatives. Cash, modified cash, tax basis. Each has its place, its logic. But for many businesses, that place isn't permanent, is it? What happens when that small business using cash basis really starts to grow? Or they need a serious bank loan, maybe attract investors, or even think about going public? They'd almost certainly have to switch to accrual basis, GAAP, right?
You've hit on a really common and critical transition point for countless businesses. Many start simple cash, modified cash, because it's easy and cheap. But you're absolutely right. Circumstances change.
Like needing serious money.
Exactly. To get a significant loan from a traditional bank, to attract venture capital or private equity, to provide clearer profitability reports to more sophisticated owners, or especially if they aim to go public or be acquired by a larger GAAP reporting company, they're almost always required to convert their financial statements to the accrual basis.
Why the insistence on accrual from banks and investors?
Because accrual accounting, particularly full GAAP, provides a much more comprehensive and arguably accurate picture of a company's financial performance and position over time. It rigorously matches revenues earned with the expenses incurred to generate them. It shows all the assets and liabilities. That cash basis, or even modified cash basis simplicity, can obscure the underlying economic reality that these external parties need to see to assess risk and potential return.
So it's a practical necessity for growth and access to capital. This isn't just theory, it's a real-world hurdle. When making that conversion, what's the absolute fundamental difference, the core concept shift we need to grasp?
The bedrock of the entire conversion lies in understanding the core timing differences between cash and accrual. It's not just arithmetic, it's a conceptual shift in when you recognize economic events.
Okay, break that down for us again.
Uh,
Revenue first.
Right, revenue recognition.
Yeah.
Under cash basis, it's simple. Revenue is recognized when cash is received. Money in the bank, boom, revenue.
Straightforward.
Under accrual basis, it's different. Revenue is recognized when it's realized or realizable, A&D earned. Basically, you've done the work or delivered the goods, and you have a reasonable expectation of getting paid even if the cash hasn't arrived yet. You send the invoice, you've earned it, you book the revenue.
So, earned, not just received. Got
Right.
it. And expenses.
Similar logic. Expense recognition. Under cash basis, an expense is recognized when cash is paid. You write the check, boom, expense.
Cash out the door.
Under accrual basis, an expense is recognized when it's incurred or the benefit has been received, regardless of when the cash is paid. Think about employee wages. They work the last week of December. You recognize the wage expense in December, even if you don't pay them until January. Or that annual insurance premium, you recognize the expense month by month as you receive the insurance coverage benefit. It's about matching the expense to the period it benefits or relates to.
That matching principle is key in accrual. Okay, so that's the core difference. Earn versus received for revenue, incurred versus paid for expenses. How does this translate to fixing the balance sheet during conversion? Pure cash basis just has cash and equity, right?
Exactly. Pure cash is very limited. Modified cash might have a few more things like fixed assets or inventory, as we discussed. To get to a full accrual basis balance sheet, you essentially have to add all the missing pieces, all the assets and liabilities that exist at the end of the year under accrual principles, but weren't recognized under the previous method.
Filling in the gaps.
Precisely. Once you've identified and added all those assets and liabilities, equity simply becomes the difference, the residual interest, following the basic accounting equation. Assets equals liabilities plus equity.
So what are the common balance sheet accounts you typically need to add or adjust?
Oh, quite a few, usually. You'll often need to recognize things like accounts receivable, money owed to you, inventory, goods waiting to be sold, prepaid expenses, like prepaid rent or insurance, maybe investments at fair value, fixed assets, properly stated net of accumulated depreciation, accounts payable, money you owe suppliers, accrued liabilities, like salaries payable, interest payable, utilities payable, unearned revenue, cash received up front for future services, that's the liability, income taxes payable, and of course, short-term and long-term debt.
Wow. Okay. So you're basically building a complete picture of all economic resources and obligations that the cash or modified cash methods might have ignored or simplified.
That's the goal, a full snapshot of financial position.
All right. That's the balance sheet. Now, the income statement conversion, you said this is where the real action, the main adjustments happen.
You're absolutely right. The income statement is where you see the most significant impact of switching from cash flow timing to accrual timing. The core tasks are 1. Converting cash basis revenue to accrual basis revenue, adjusting for receivables and unearned revenue. 2. Converting cash paid for purchases into accrual basis cost of goods sold. This involves looking at inventory changes and payables. 3. Converting cash paid for operating expenses into accrual basis operating expenses, adjusting for accrued liabilities and prepaid expenses.
Okay.
And here's that really neat connection I mentioned earlier, something that can be a huge help if you're learning this. The process of converting the cash basis income statement to the accrual basis income statement. It's the exact opposite of the process used to prepare the operating section of the statement of cash flows from accrual basis statements.
Wait, say that again? The opposite.
Yes. If you know how to calculate cash flow from operations, starting with accrual net income, adding back depreciation, adjusting for changes in working capital like AR, AP, inventory, etc., then converting cash basis income to accrual basis income uses the inverse of those adjustments. If you add an increase in AR to get from accrual to cash flow, indirect method, you subtract it to get from cash to accrual. It's a perfect mirror image.
That's a fantastic mental model. If you understand one, you can reverse it for the other. Brilliant.
It really helps click things into place. Now, beyond those core conversions, there are other adjustments needed, too, for the income statement. You have to recognize non-cash expenses, like depreciation and amortization. Cash basis ignores these. Accrual requires them.
Right, spreading the cost of assets.
You need to capitalize purchases of fixed assets.
Yeah.
That $5,000 cash paid for equipment isn't an expense. It becomes an asset on the balance sheet. So you effectively remove that cash outflow from the expense calculation. If you sold any fixed assets, you need to remove the asset's book value and recognize the actual gain or loss on the sale, not just the cash proceeds.
More complex than just cash received.
Definitely. And if you received loan proceeds, that cash inflow isn't revenue. It's recorded as a liability.
Got it.
And debt repayments aren't just cash outflows or expenses, they reduce the liability on the balance sheet.
Okay, that clarifies the range of adjustments.
Yeah.
Let's get practical. Can we walk through the formulas for those main income statement conversions, revenue, cost of goods sold, operating expenses, starting with revenue? How do we get from cash collected to accrual revenue?
Absolutely. Let's break down the revenue conversion formula step by step, thinking about why we make each adjustment. You start with cash basis revenue. That's your known quantity, the actual cash collected from customers during the period.
Okay, starting point.
Then, you plie beau, ending accounts receivable, AR. Why? This is revenue you earned this period by providing goods or services, but the customer hasn't paid you yet. Since accrual recognizes revenue when earned, you add this amount. It belongs in this period's revenue.
Earned but not received. Add it. Makes sense.
And then, you minus beginning accounts receivable, AR. This represents cash you collected this period, but it was for sales you made and revenue you earned in a prior period. It was an OCHO at the start of this year. So you subtract it because it's not revenue earned in the current period.
Received but not earned this period. Subtract it. Got it.
Next, you minus ending unearned revenue. This is cash you received this period, maybe as an advance payment or deposit, for services or goods you haven't delivered yet. You haven't earned it yet, so under accrual, it's a liability, not revenue. Subtract it from the cash received.
Received but not earned yet. Subtract it. Okay.
Finally, you PLS use IMC. This is cash you received in a prior period, but you actually earned it in the current period by delivering the service or goods. So you add it to this period's revenue because this is when the earning process was completed.
Earned this period but received earlier. Add it. Perfect.
And that calculation gives you accrual basis revenue. It requires having those beginning and ending balance sheet amounts for AR and unearned revenue, which, in any practical problem or real-world conversion, you would have available.
That logic flows really well. Each step adjusts for the timing difference between cash and earning.
Okay, what about converting cash paid for purchases over to cost of goods sold, COGS? How does that work?
Similar logic, but focused on inventory and payables. The goal is to find the cost of the inventory that was actually sold this period. You start with cash paid for purchases, the actual cash outflow during the period to buy inventory.
Starting cash paid. Then, you PLOS ending accounts payable, AP. These are goods you receive from suppliers and thus incurred the cost this period, but haven't paid for yet. Since accrual recognizes expenses when incurred, you add this. It's part of this period's purchasing activity cost.
Incurred but not paid. Add it.
Right. Then you minus beginning accounts payable, AP. This is cash you paid this period, but it was for goods you received and incurred the cost for in a prior period. You subtract it because the cost doesn't relate to this period's activity.
Paid but not incurred this period. Subtract it. Okay.
Next, you minus ending inventory. This represents the cost of goods you purchased, either this period or previously, that are still on hand and unsold at the end of the period. Since COGS is only the cost of goods sold, you subtract the cost of what's left over. It's still an asset.
Purchased but not sold. Subtract it. Makes sense.
Finally, UPLUS beginning inventory. This is the inventory you had on hand at the start of the period. Since it was available for sale, the portion of it that was sold during the period needs to be included in the cost of goods sold calculation. Adding beginning inventory and subtracting ending inventory effectively isolates the cost of goods sold.
Sold this period but purchased earlier. Add it back, in essence. Got it.
And that calculation yields cost of goods sold on an accrual basis.
Excellent. One more major conversion. Operating expenses. How do we get from cash paid for things like rent, salaries, utilities to the accrual basis operating expense?
It's the same principle. Adjust the cash paid figure for timing differences related to prepayments and accruals. Start with cash paid for operating expenses, your total cash outflow for these items.
Cash paid baseline.
Then PLUS ending accrued liabilities. These are expenses the business incurred this period but hasn't paid yet, like unpaid wages at year end, or utility bills received but not yet paid.
Yeah.
You add them because they're expenses of this period.
Incurred but not paid. Add. Okay.
Then minus beginning accrued liabilities. This is cash paid this period for expenses that were actually incurred in the prior period. Subtract it because it's not an expense of this period.
Paid but not incurred this period.
Subtract.
Right.
Next, minus ending prepaid expenses. This is cash paid this period for benefits that will be received in future periods, like paying next year's insurance premium in December. Subtract the portion that benefits the future because it's not an expense of this period. It's an asset.
Paid benefits future. Subtract. Got it.
Finally, PLAUS beginning prepaid expenses. This represents payments made in prior periods for benefits that were actually received or used up in the current period, like the portion of last year's insurance payment that covered this year. Add it because it's an expense of this period.
Benefits this period but paid earlier. Add. Perfect.
And that gives you accrual basis operating expenses. And remember that helpful hint. This general formula works for total operating expenses. Or you can apply it to specific expenses like salaries or insurance if you have the specific beginning and ending payable prepaid balances for those items.
That's incredibly clear. Having those formulas broken down by the why makes them much less intimidating. It's all about adjusting for timing. Now, can we see it all come together? An example is where it really solidifies.
Absolutely. Nothing beats putting numbers to the concepts. Let's use ABC Company for year 6. Here are the facts. ABC had cash collections of $50,000 and made cash payments of $20,000. So their simple cash basis net income was $30,000 for year 6.
Okay, $30K cash basis income.
Now, we need those beginning and ending balance sheet figures to make our accrual adjustments. Accounts receivable, AR, went from $10,000 at the start of year 6 to $15,000 at the end. So an increase of $5,000. Prepaid insurance went from $2,000 to $4,000, an increase of $2,000. Unearned service revenue went from $20,000 down to $5,000, a decrease of $15,000. Salaries payable went from $3,000 up to $7,000, an increase of $4,000.
Got the balance sheet changes.
And one more key piece. On January 1st of year 6, ABC bought equipment for $5,000 cash. It has a 5-year life, no salvage value, straight line depreciation.
Okay, so $5,000 depreciation expense per year. 5,000, 5 years.
Exactly. That $1,000 is a non-cash expense we need for accrual. All right, let's compute ABC's year 6 accrual basis figures. 1. Calculate accrual basis revenue. Start with cash collections, $50,000. Adjust for AR. Ending AR 15K is higher than beginning AR $10. That $5K increase means we earned $5 more than we collected, so plus $5,000. Adjust for unearned revenue. Ending unearned, 5K is lower than beginning unearned, 20K. That 15K decrease means we earned 15K of revenue this year that we collected cash for previously, so plus 15,000. Calculation. $50,000 plus $5,000 AR. Increase plus $15,000 unearned decrease, $70,000 accrual basis revenue.
$70,000 revenue. Okay, big jump from $50,000 cash.
It is. Reflects the revenue actually earned. Now for expenses. 2. Calculate accrual basis expenses. Start with cash payments, $20,000. Start with cash payments. First, deal with that equipment purchase. That $5,000 cash outflow wasn't an expense, it was buying an asset. So we need to back it out of the cash paid for expenses figure. Conceptually, you remove it. Then, add the non-cash depreciation expense, plus $1,000. Adjust for salaries payable. Ending payable $7 is higher than beginning payable, $30K. That $4K increase means we incurred $4K more salary expense than we paid in cash, so plus $4,000. Adjust for prepaid insurance. Ending prepaid $4K is higher than beginning prepaid, $2K. That $2K increase means we paid $2K cash for insurance that benefits the future. So this reduces this year's insurance expense relative to cash paid, so negative $2,000. Calculation. Let's think about the components of the $20K cash payments. Assume $5K was for the asset, leaving $15 for other operating payments. Accrual expenses $15K operating cash payments, plus $1,000 depreciation, plus $4,000 salary payable increase, $2,000 prepaid insurance increase, $18,000 accrual basis expenses. Alternatively, using the full formula method on the $20K cash paid, $20,000, $5,000 remove asset purchase, plus $1,000 depreciation, plus $7,000 end sal pay, $3,000 beg sal pay, plus $2,000 beg prepaid, $4,000 in prepaid, $18,000.
$18,000 in accrual expenses compared to $20,000 cash payments.
Interesting. Driven mainly by capitalizing the asset and offsetting accruals prepayments.
Exactly. Now for the bottom line. 3. Calculate accrual basis net income. 3. Calculate accrual basis net income. Accrual revenue, $70,000. Accrual expenses, $18,000, $52,000 accrual basis net income.
Wow. Okay, so let's compare. Cash basis net income was $30,000. Accrual basis net income is $52,000. That is a huge difference. Over $20,000 higher profit under accrual.
It really demonstrates the impact, doesn't it?
It absolutely does, and you can see exactly why. It's recognizing revenue earned but not received, recognizing revenue received previously but earned now, adding non-cash depreciation, and adjusting for those changes in payables and prepayments. It paints a profoundly different picture of profitability for year 6. #tag outro.
And if you connect that back to the bigger picture, understanding these frameworks, understanding that conversion process, it's just incredibly valuable. It shifts your perspective. You move beyond just tracking the cash in the bank account, which is important, yes, but limited.
to truly understanding the underlying economic reality of a business's operations during a period. Its actual earnings, its obligations, its assets. And that deeper understanding is vital, whether you're looking at a small business, maybe evaluating a nonprofit, or just trying to make sense of the different ways financial health gets reported out there.
That was a deep dive indeed. We went from the basics of OCBOA, why these other frameworks even exist through their ground rules, into the specifics of cash, modified cash, and tax basis, and then that detailed walkthrough of converting to accrual, seeing how those adjustments can drastically change the bottom line. It really makes you think, doesn't it? How much might you be missing about a company's real financial health if you only see one type of statement, or if you don't understand the specific rules being used? And it makes you wonder, what other accounting choices, even within GAAP itself, might be subtly shaping the numbers we see every day? It really encourages you to look closer, to ask more questions.
Indeed. And that deeper understanding, that ability to look beneath the surface numbers, is where the real value lies. It's knowledge you can truly apply.
Absolutely. Well, that's all the time we have for this deep dive. We'll be back next time, ready to unpack another stack of sources for you. Until then, keep learning and stay curious.